Hey guys, Roland Hermio with Safe Financial with a couple of frequently asked questions and a quick case study. Okay, so one of the most common things that we get asked, one is, if I have life insurance at work, why do I need another policy? Okay, the other is, if I have plenty money in the bank, do I still need a policy? Because conventional wisdom out there might be that if I've got plenty of money in the bank, why would I need life insurance? And there's some truth to that, but let's go over the numbers and see what makes sense. And then if you do get a policy, term or permanent, which one makes more sense, right? So for our case study today, Joe is 58 years old, lost his first wife to cancer, has since remarried. Current wife is 12 years his junior, and they have a 2-year-old girl together. Okay, so one point is that he does have life insurance through work, which is equivalent to 2 times his income at 180 grand. So he's got $360,000 worth of coverage. Now that covers this question up top where it says, I have life insurance through work. One thing to note, especially you guys that are lifers in your job, if you're a teacher, teachers tend to stay at a job very, very long time. Longevity is great, but one thing they're not thinking about is most policies are either not portable, or if they are, they can be very expensive when you leave that job and you decide you still need life insurance to take it with you. It might be a little too expensive to do. Okay, now most jobs will use what they call annual renewable term, meaning that the older you get, the more expensive that policy gets. So in the early years, it's pretty inexpensive because you're still young. But once you get past 60 and 70, that curve really climbs quite a bit. Okay, so to answer the question of having coverage at work, just understand that most of the time you can't take it with you. It's not portable. So if that's the case, you need to know that up front. So you should get a policy outside of work if you feel the need to have coverage. Obviously, with a wife that is 12 years his junior and a 2-year-old, he's already 58. I don't know how much longer he plans on working, but as soon as he leaves that job, that 360 falls off. Now, we looked at a 20-year term policy for him at $250,000. It's going to run him about $170 a month for 2 years, for 20 years. If you do the math, that's about $40,800 of premium to cover 250. If you die inside that 20-year period and the policy's in force, not a bad deal. You pay for 40,000, you get 250. Now, should you die in year 21, past the policy term, then the 40,000 is gone, so is your coverage. So another way to look at it, and this is really one way that we can fund this thing, is Joe's got money in the bank, right? I don't know where it came from. We didn't really discuss, but it's possible. It was a death benefit from the previous wife. Don't know the real reason or the source, but he's got plenty of money in the bank. We had a fact finder. He's got cash sitting in a savings account, hardly earning any interest. So that is really the first place I would go to fund this. Rather than looking at it as a cost, which it is when you buy a term policy, you're going to pay $170 a month, 240 times or 20 years equals a little bit under 41,000 in cost. Now, what if we took money that's sitting in a savings account or a checking account earning nothing and bringing it over from this bucket to that bucket, which is here, right? Taking it from your bank and sending it to the insurance company. This is hardly earning any interest. You bring it over here. Now, in this strategy, I'm suggesting 15K a year. And I know that sounds like a lot of money to you guys, and it is. But keep in mind, Joe's had it sitting in this account for years, not earning anything. We're just gonna move the money from one parking spot and put it in the other parking spot, okay? And we're gonna do this transfer, and here's the reason. We're gonna do this transfer at the tune of $15,000 a year or $12.50 a month. Now, you might say, why in the world would we do that? One, by buying the policy gives him leverage, meaning that for this much money, he's getting control of this much dollars, right? And it will grow tax deferred, just like a 401k. It'll grow tax deferred. You don't have to pay any taxes on it as it grows. That's what that means. To the tune of $15,000 a year or $12.50 a month. He's buying this policy, which has a base death benefit of 50. Now that 50 is quite a bit less than 250, but follow me on this thing, okay? So in 8 years of funding at 15K a year, okay, we're gonna show that he has paid in $120,000 in total premiums. Again, that's money sitting somewhere, not earning anything. You're gonna put it here where it's gonna earn something. After 8 years, it's $120,000 put in. Sitting in cash value is $119,000. So for the most part, he has broken even. Now, in this policy, by the time year 8 comes around, that 50,000 in death benefit is now 270,000 in death benefit on the whole life side. There's a term rider, 478,000. Now, the reason for the term rider is to be able to put this much money into the policy. We had to do this, and that's another video at another time. But for now, just accept the fact that for IRS rules, we were required to put in a policy, a term policy in there to be able to accommodate this much funding. So at year 8, you're sitting on $448,000 worth of death benefit. Now keep in mind, you started at 50, but because the cash value rose up so much, it pushed the death benefit on the whole life to 270. Still sitting on 178,000 a term rider, giving him a total death benefit of 448 at year 8. Okay. Now, something of note in this type of policy, there's, depending on the carrier, there's going to be either chronic or critical illness available as coverage, meaning that if you get seriously ill with cancer, stroke, major heart attack, that's critical illness. And then chronic illness, if you're unable to take care of yourself, you can't go to the bathroom on your own, can't bathe yourself, can't feed yourself, can't take medicine on your own, in and out of bed by yourself. Basically, the activities of daily living. Between the chronic and critical illness, you're able to make a claim, and the insurance carrier will give you a percentage of that death benefit. Let's say, one of my clients had cancer, couldn't work for a year and a half. Insurance carrier sent her 160 grand for the year and a half that she couldn't work, so that she can pay her bills while she's still living. Now, it's a life insurance policy. It pays when you die, but with living benefits, it also pays if you get major illness or injury and you can't work. So the benefit is there, right? So again, how much did it really cost Joe for the policy? I mean, if you say you're taking it from one place and put it in the other, other than opportunity cost, didn't really cost him anything, especially by year 8, because he had access to that money throughout the years all along. So it didn't really cost you anything because you're only moving it from here to there. Now, obviously, there's premium, there's insurance costs built in, but visually, if you're just saying, okay, I'm taking it here, that's not earning interest, and I'm moving it here, and I get these benefits out of it. And this is a snapshot at year 8. Okay. Now this is a permanent policy. It keeps going. At some point, this 178 will drop off on purpose so that we can reduce our cost of insurance as we grow our cash value inside the policy. Okay. So to review, instead of doing the term, this tends to work out better because this will keep growing the cash value. By year 8, net cost not really there because there's as much money as you put in as there is available to take. You've got a total death benefit of 448, 178 of which will drop off at some point, probably in year 11. But your 270 death benefit is growing right along with your cash value over time. Okay, but I'm just making a point that after 8 years of doing this strategy, you have gotten the money back that you shifted from one bucket to the next. So to answer that question, do I need life insurance if I have plenty of money? Well, if you have plenty of money, shifting that money from one place to the other actually ends up going to your benefit, because you're yielding a high death benefit on a policy that, for all intents and purposes, if that money was just sitting there, it'd still be there instead of here, but it didn't do anything, right? A couple of things you can do with that same bucket of money. This eventually keeps growing. You can take a portion of that in retirement. Let's say he stops working. Take a portion of that in retirement and you can put it towards rental property. Let's say you buy a double, triplex, or a fourplex. You take the money from the policy, you use it as down payment towards the rental. And then you're going to collect rents. Eventually, you're buying down the debt on that rental property. And most of the time, real estate tends to go up in value. So you're building equity into a rental property using down payment from the same policy that was just sitting there doing nothing. So you take lazy money, make it productive, take the money, put it down on a rental property in retirement. The rental property will yield a net profit on the rents. Your tenants are paying your mortgage down. Mortgage is being paid down over the years. Property appreciates. It's working out really well. Okay? And you can extrapolate on from there. You can buy another property, right? One other use for this that I really like that most people don't really talk about is using the money built up in the cash as what you call a volatility buffer. Volatility buffer, what is that? Volatility buffer is a extra bucket of money used typically after retiring that is not tied to the market. Now, why is that important? Most guys, and I'm sure Joe does too, has a 401k through work or an IRA, and you build it up over years, right? So you've got, say, 40 years worth of savings built up in your 401k. You stop working, the paychecks stop. Now you have to live off of that savings bucket that you accumulate over the years. Now, in the very end of your retirement period, your working period, and early in your retirement period, that first 10 years is a very crucial time, because any downturns to the market greatly affects, that happens in the beginning, greatly affects what happens to your overall income plan in retirement. In other words, the studies have shown that in the early years, if the market happens to take a dive, you may end up either running out of money or depleting your savings a lot faster than you would if the market was up in the beginning of your retirement. So should that happen, the idea with the volatility buffer, an extra bucket of money that's not tied to the market, is that if the market happens to be down when you first retired, let's say it goes down 36%, rather than pulling money from that bucket that's down in value because of the stock market taking a dive, if you had another place to pull money from here to tide you over for that year, instead of pulling it from that portfolio and locking in that loss, you are pulling from your own money that's not tied to the market and giving that portfolio time to recover. That's what a volatility buffer is, and that's what it does. So a lot of uses for cash value life insurance outside of just the death benefit, or comparing it to investments. No, it's never going to outperform stock market returns, nor was it ever meant to be. But if you're using your money wisely and you're truly diversifying your portfolio, a portion into this strategy makes the other investments better. It allows your 401k to recover should the market take a dip because you had somewhere else to pull money from. Again, cash value life insurance is not necessarily there, and it won't be. It's not there to compete against your 401k. It's actually there to complement it. It makes your 401k work better. And at the end of it all, right? So eventually, if you live long enough, even though the 178 dropped off, this death benefit it will keep increasing because of compound interest over time. Or in a case of a whole life policy, dividends and paid up additions keep growing that death benefit. And that, as a complement, also allows you to do one more thing. It allows you to enjoy your money that you saved in your 401k a lot better than if you're holding on to it so tight because you're worried about not spending all your money. Well, guess what? If you knew that, let's say, years down the line, you had $600,000 worth of death benefit to pass on to your new wife, you can spend a little bit more liberally on your savings rather than holding on to it so tight because you're worried about running out of money to pass on to the missus and, at the time, a 2-year-old kid, but by then probably be a lot older. So there you go. Life insurance from work. Does it make sense to buy anything if you have it at work? The answer is yes, because you can't take it with you, and the very few that you can could cost you too much money, right? If I have money, does it make sense to buy it? If you have money, you're not spending the money like you are here, buying, paying the premiums and then losing it if you outlive the policy. You're taking money that's parked somewhere, earning nothing, bring it over here. Now it's going to do a lot of work for you. Buys rental property. It's a volatility buffer. It's a number of things. So obviously the answer to term or permanent, I'd say both, right? You can buy $1 million in term pretty cheap and complement that with a policy that started off at $50,000 permanent, but ends up growing over time. Just one of those many strategies. So frequently asked questions, case study, hope that helped. Roland Harmio, Safe Financial. You can reach us at 985-464-9595. See you next time.